The main way that a long horizon lowers risk is that it certainly lowers the chance of loss. So if you want to, if you invest in a portfolio or a risky gamble, even like a coin flip, that has a positive expected return, the more times you play and the more patient you are, the more likely it is, probability-wise, that you'll end up with a gain. Time does not remove risk, it just changes it, right? It reduces the likelihood, but it increases the tail and the severity. Right. And so it's not removing the risk, it's changing it. And I think that means what we need to focus on is studying the long-term risk. We can't just assume it isn't there. And in fact, we have to study it more because it's different. The chance that your portfolio is down 10% at some point is, of course, always larger than the chance that it's down 10% at the end.
Yep.
It's that plus some. Yep. And the plus sum is quite big.
Right.
Than the risk that you had just at the end. That's the first point. I guess the second point is that the longer the horizon, the larger the chance that you suffer a certain drawdown, a particular size of drawdown.
Yeah.
The more time you play, the more possible it is to get an unlucky streak. Repeating your bet exposes you to larger losses. So it's different than diversifying across a portfolio. One way to think about it is if you're investing just in, let's say, stocks and bonds, would you rather be 50% stocks, 50% bonds all of the time, or 100% bonds and 100% stocks half of the time each? So you'd think, well, is it diversifying to just, switch off and keep repeating these things? Not really, because, in the time that you happen to be in stocks and the market happens to fall, you're not diversified at all. So the diversification needs to happen coincident to the losses that you're having. So that's why this notion of repeating your investment bet doesn't really diversify, because you're taking a new bet each time. You're not offsetting or spreading your bets across something. You're just repeating them. If you're super aggressive in rebalancing, then you chase the market down once in a while and you have large losses. And they're worse than other people would get if they did nothing. So obviously there are times when you benefit. If you have a coronavirus type V-shape of stock returns, you're going to benefit from rebalancing. So the interesting thing is that I don't think there's a free lunch. Anything can happen and probably will happen at some point. So what's the spectrum of outcomes, and what kind of risk are you taking? So I think it's a bit of a fallacy that frequent rebalancing is the safest thing to do. If you have a long-term horizon, it can end up exposing some of these incremental risks. Investors probably care about the long run and the medium and the short run. It's not one or the other. I think one of the fundamental points here is that those two are actually in conflict. You can't necessarily minimize risk across the board. And the simplest way to look at that is, what's the safe asset for the short term? It's cash. What's the safe asset for the long term? Is long-term government bonds, really. I mean, cash as a long-term investment is actually quite risky. So you can't have it both ways. And there's interesting examples of that, I think, going beyond it. If you look at, you look at equities, they are going to have a larger expected return. So they're going to have less drawdown risk, in the very long run against, let's say, an inflation objective, but they're going to have a lot more risk in the short run. So I think most investors need to balance those two factors, that both horizons are probably relevant, but to different extents. simplifying to a discrete set of scenarios. Instead of saying, well, anything can happen, there's an entire bell curve distribution of stuff that can happen. Let's simplify it to 5 scenarios: moderate, sort of good, really good, sort of bad, really bad, and study those and get the probabilities of those. And it can be, I think, an accurate representation of the full range of outcomes. And certainly the statistics are helpful. But thinking of it in terms of concrete scenarios, I think makes it easier to visualize how favorable or painful those scenarios are going to be.